Welcome to my channel, Cagayatrisacademy, and today we are going to deal with a very important topic, that is, what should the auditor do if management imposes a limitation on the scope of audit before acceptance? This answer will be as per Essay 210, which deals with agreeing the terms of audit engagement. Essay 210 deals with limitations on scope before accepting the audit engagement. Let's understand one of the most important and frequently asked questions on this concept of Essay 210. Imagine the situation. Suppose a company approaches you and says, "Sir, we want you to conduct our statutory audit, but there are a few conditions." You reply, "Sure, what are they?" The management says you cannot verify your inventory, you cannot examine certain bank accounts, you cannot communicate with our legal advisors, you cannot inspect a few important files. Now ask yourself this one simple questions. Can you give an independent audit opinion if the client decides what you can and what you cannot verify? Obviously, no. The auditor's opinion is valuable only because it is based on sufficient appropriate audit evidence. If management blocks access to important evidence even before the audit begins, the auditor already knows that enough evidence cannot be obtained. What does Essay 210 says here? Essay 210 clearly states that if management or those charged with governance impose a limitation on the scope of the audit work before accepting the engagement, and the auditor believes that the limitation will result in disclaimer of opinion, the auditor should not accept the audit engagement. The only exception is when the auditor is required by law or regulation to accept the audit. Why is this rule so important? Remember this principle: an audit is not conducted according to the client's wishes. It is conducted according to the standards of auditing. If management starts restricting the auditor from day one, the auditor's independence and ability to collect evidence are already compromised. Therefore, SC 200 protects the credibility of the auditor or audit profession by saying, don't accept an engagement that is impossible to perform properly. Let's take an example. ABC Limited appoints Mr. X as statutory auditor. Before signing the engagement letter, management informs him, you will not be allowed to verify the inventory stored in our warehouse because it contains confidential products. Inventory is a material balance, right? Without verifying inventory, the auditor may not obtain sufficient appropriate audit evidence. As a result, the audit report may ultimately require a disclaimer of opinion. Therefore, under Essay 210, Mr. X should refuse to accept the engagement unless some law specifically requires him to undertake the audit. No evidence means no opinion, no actors. If management blocks evidence before the audit starts, the auditor should simply walk away rather than accepting the engagement. That cannot be completed in accordance with the standards of auditing. As per Essay 210, if management or those charged with governance a scope limitation before acceptance of the audit engagement, which the auditor believes will result in disclaimer of opinion, the auditor shall not accept the engagement unless required by law or regulation to do so. Thank you.